This is Law Bytes, a podcast with Michael Geist.
Stablecoins, digital tokens pegged to the US dollar, are no longer just a niche tool for crypto traders, and new US legislation is bringing them into the regulated financial mainstream with the potential to reshape payments and global finance.
Stablecoins have increasingly begun to enter the mainstream, with previously reticent policymakers, regulators, and financial institutions now shifting towards frameworks that seem more supportive of their development. For example, last month, Ron Morrow, the Bank of Canada's Executive Director of Payments, told an Ottawa conference that, and I'll quote, "Governments are moving to regulate stablecoins and other cryptocurrencies so consumers can reap their benefits and be protected from credit and liquidity risks. In fact, many jurisdictions worldwide either have or will soon have a regulatory framework for crypto assets." He suggested that Canada, quote, "weigh the merits of federal stablecoin regulation similar to what other countries have done." Mohamed Zohiri is a legal counsel and Fintech advisor at the Alberta Securities Commission, who has focused on stablecoins and their regulation for many years, both during his graduate legal work and at the ASC. He joins me on the podcast to provide an introduction to stablecoins, examines the new U.S. legislation that may spark increased investment, and outlines where Canada currently stands on the issue. Mohamed, welcome to the podcast.
Thank you for having me, Michael. It's great to be here.
Yeah, no, I'm really happy that you've come on. It's not every week that I get to have a former graduate student who parlay some of the work that you were doing in grad school into issues that become so important that we need to focus them on a podcast. So it's fantastic that you've taken the time out to come on. And that issue that we're going to be talking about is stablecoins, which has been attracting an increasing amount of attention. I think it's fair to say it is starting to really spread beyond just the crypto world. Given the increasing emphasis and growing prospect of regulation, I thought it was time really to devote an episode to better understanding what's happening, what may lie ahead. And as I mentioned, you're really the perfect person to do that, given that you were studying and writing about stablecoins many years ago. Why don't we start then with a basic 101, stablecoin 101. For the uninitiated, what are they?
Before I get started, I'd like to just qualify my statements. I am lawyer and legal counsel and fintech advisor for the Alberta Securities Commission, and so anything I say shouldn't be taken as legal advice or reflect the views of the ASC or the Canadian Securities Administrators. So I think as a starting point, what stablecoins are, I think, simply put, I think they can be viewed as a digital asset that is designed to maintain a stable value by referencing some sort of fiat currency or other types of assets like commodities like gold or silver, of those types. I think it's good, a good analogy or a good way to think of stablecoins is a type of programmable digital cash. They combine the stability of traditional money with the speed and programmability of blockchain technology. So I think the technical foundation is that they run on public blockchains, they use smart contracts, and they enable 24/7 global transfers sort of at a minimal cost. So a good way to think about this is that, I'm sitting here in Calgary, and, I have some family that are, in overseas. I'm able to send them those funds in as little as 30 seconds, let's say, and for a minimal cost of, say, under $1.
Okay. So they're a fast way to engage in remittances or transfers, and they have the benefit of having a standard that's commonly understood, let's say US dollars, but of course it could be other kinds of currencies as well. One often reads about different kinds of stable coins, say backed stable coins versus algorithmic stable coins. Can you explain a little bit or provide a little bit of a lay of the land about the different kinds of approaches we see with respect to
Yeah, I
stablecoins?
think, that's a great question, Michael. Thanks. I think, I think it's important to understand if we back up a little bit before I get into sort of like the nuances between the different types of stable coins. I mean, stable coins have some core value propositions to them, such as, the price volatility, minimization versus other types of crypto assets like Bitcoin or Ethereum. There's speed, near instantaneous settlement versus, say, like traditional banks where traditional banking rails, which could take, anywhere from 2 to 5 days. The cost. So again, when we're talking about remittances, low international transfer fees versus, wire transfers. The smart contract integration for automated payments and the 24/7 global availability, which are not restricted by, say, like traditional banking hours. And so these sort of core value propositions sort of underpin most stablecoin operations. And now, so when we're thinking about sort of the different types of stablecoins and what their differences are, essentially the differences are how they stabilize the pricing in reference to the fiat currency. And so when we're thinking about fiat-backed stablecoins or collateralized off-chain stablecoins, the mechanism is that it holds a one-to-one reserve held by some sort of private issuer. So, and those reserves are generally comprised of cash or other types of high-quality government-type assets like treasury bills or commercial paper of some sort. And some examples of those types of stable coins are USDC, which is issued by Circle, or USDT, which is issued by Tether. And so they have a bit of a different risk profile, such as the risk, the reserve quality, the custody, what are the redemption guarantees, the bankruptcy remoteness of the reserves. And so these are predominantly the most popular types of stable coins. Now, the other types are things like crypto-backed stable coins, and we can think of ones like MakerDAO, for example, and their DAI stablecoin. These types of stable coins are over collateralized and they generally use other types of crypto assets. So those reserves can be comprised of Bitcoin, Ether. I think MakerDAO is now starting to include other types of stable coins within their reserve composition. But these are generally over collateralized anywhere from 150 to 200%. The risk profile there with collateralized stable coins is generally the liquidity risk during market crashes. And because they're decentralized and managed through a decentralized autonomous organization, there's no single point of failure. So they're not a centralized entity. And then algorithmic stablecoins. So these mechanisms use smart contracts that adjust supply and demand without any sort of reserve backing. And so for a historical context, you can think about Terra Luna and the UST collapse that happened in May of 2022, where in a single day, $45 billion was wiped out. Case study or historical lesson into some of the risks that stablecoins may pose to the market. And so some background, UST was offering 20% yields through an anchor protocol, which attracted nearly $18 billion total value locked in the protocol. The trigger was on May 8th of 2022, there was a large redemption for this particular stablecoin breaking its $1 peg. And so it went into a death spiral. The protocol minted excessive Luna tokens to try and defend the peg. And then the hyperinflation of that minting process destroyed, both assets, both Luna and the UST stablecoin. And then this obviously led to contagion risk, which led to 3AC, Voyager, Celsius bankruptcies, and in my opinion, I think contributed to the FTX collapse. Just a small plug. I know you've had Dr. Ryan Clements, who's my director here at the ASC, on on your podcast in the past, but he wrote a great paper on this topic. I think your viewers would be great to go read it to give you a sort of an in-depth look into how algorithmic stablecoins pose a danger to the market. And he actually wrote this, prior to the Luna collapse. So he was a bit of a prophet, I would say, in predicting that failure. But I think some of the key points is that the Terra collapse demonstrated why, regulatory oversight matters. Algorithmic designs without sort of proper backing can create a significant systemic risk.
You're right. That piece really was quite prescient and really predicted in advance where things might go.
Yeah.
So just to make sure that I'm understanding and the listeners are understanding, you've really identified three different types of stable coins. The most stable, so to speak, would be, and the examples you provided would be Tether or Circle. USDT and USDC are the symbols or acronyms that are used. And so those are backed on a one-to-one basis. Essentially, for every USDT dollar, let's say, every stable coin, there is some equivalent amount of high quality value that backs it. You mentioned cash, It could be treasury bills and the like. The second that you mentioned is also backed, but it's backed by crypto. So, some may have some amount of skepticism there because of some of the volatility associated with it, and I assume that's why it's over collateralized, as you mentioned. So, just to provide people with a greater level of safety, rather than 1-to-1, it might be 2-to-1 or 3-to-1 or whatever it happens to be, so that if the value does decline, that dollar is still there. And then we get this third algorithmic type that you mentioned. There are some risks where it is using smart contracting and other mechanisms, the arbitrage and the like, to try to ensure that it keeps the peg, so to speak. It keeps that $1 in place. Do I have a sense of, is that what the lay of the land looks like?
Yeah, yes, yeah, I think you're right. And I think I would just add that, at the CSA, we don't actually use the term stablecoin. And I think this sort of highlights that even though some of these pricing mechanisms or stabilization mechanisms are good, especially in fiat-backed stablecoins, they're not perfect and they don't necessarily keep a stable peg all the time. And so I think it's a bit of a misnomer. And we've used the term value reference crypto asset or fiat-backed crypto asset to sort of just highlight that it's referencing a value, but it's not necessarily stable 100% of the time.
Yeah. Okay. Interesting. I guess one last question about just sort of the basic mechanics of this. If we're dealing, let's say, in the world of an asset that is backed on a one-to-one basis, is it possible for someone to go, let's say, to Tether and say, okay, here I have 100 USDT, can I get the equivalent in cash for it?
Yes, yeah. And so that's been much of the work that we've been thinking through, and when it comes to redemption policies and redemption risk, when it comes to a stablecoin issuer. But yes, theoretically, I mean, the process is with Circle or with Tether, that authorized participants in their network are able to redeem that particular token for cash that is sitting in their reserve assets.
I think it's a good starting point to understand what we're even talking about here. Now, it seems to me that up until pretty recently, regulators, whether banking, securities, et cetera, were pretty skeptical about this, perhaps part of it coming out of some of the collapses that you highlighted earlier, which presented some real risks. Can you talk a bit about what that regulatory environment looked like, and then we can get into some of the significant shifts that we've seen pretty recently, especially in the United States?
I think some historical context here is helpful. When we're thinking particularly and specifically within stablecoins, I think when we're thinking about the risks that are apparent with stablecoin structures, bank runs is one of them. So stablecoin redemptions could destabilize traditional banking and crypto markets. So if we think as an example, the recent failure of Silicon Valley Bank, which was 2023, I believe, USDC had a portion of their reserves held by that particular bank. And so with its failure, it caused a depeg over the days. And luckily the Fed stepped in and guaranteed those deposits, which it was able to regain that peg. But I think that just highlights that, some of the risks that come along with stablecoins are very much bank-like in nature. And so, the reserve quality is important to understand in order to address some of those liquidity and capital concerns. So when we're thinking about like what is in the reserve, so at the time, when we're thinking historically, sort of pre 2022, 2023 in Canada anyways, it was unclear, what's the backing and what's the and is there a potential for sort of a shadow banking type of product to emerge for fractional reserves. And then also that interconnectedness between the crypto market, crypto DeFi markets and traditional financial systems. And so, size here matters. Like currently, right now, the current market cap for the stablecoin market, and this is changing daily. But the last time I looked at those numbers, it was over 300 billion US in market cap, which and think in my view represents a systemic risk type of threshold. And then I also think it's important to think about some of the consumer protection issues. Lots of misleading marketing in the early days of stablecoin issuing, and especially when we think about the Terra Luna collapse, the claims of being fully backed without, necessarily transparent disclosure around, what does that mean to be fully backed? Redemption rights, unclear what the legal claims are on an issuer in the event of an insolvency. Are folks holding these tokens going to be able to redeem their tokens for cash that's sitting in a reserve? What are the sort of regulatory gaps, between, banking, securities, and maybe payment oversight? And then also, it's also, important to highlight that, unlike a bank, stable coins and the reserves do not have any government guarantees like CDIC, insurance. And the anti-money laundering and terrorist financing rules that are in place in Canada, at the time, it's very difficult to trace who has beneficial ownership of these tokens. Understanding sort of cross-border flows, so in the early days of stablecoin issuance, being able to circumvent sort of traditional money laundering monitoring systems. And then also sanctions evasion. So there's a potential for sort of illicit finance, terrorism financing. And then, there's the compliance burden. As regulators, it's important to be, I think, in my opinion, tech forward and think about these sort of innovative types of new technologies. But these new technologies require sort of updated subject matter expertise and updated, frameworks to help, monitor these systems.
All right. So you've identified a lot of legal issues.
Yeah.
So much so that someone who's not familiar with this would say, well, why do I want to deal with any of this sort of stuff, given sort of all the kind of risks that you just identified. But what we have seen, especially in the last number of months, last year or so, is a pretty dramatic shift in the United States in particular when it comes to this issue. It essentially feels as if the U.S. has come of the view that this is going to happen with or without regulators, and the opportunity to regulate and the opportunity to have US dollars be the de facto currency when it comes to many of the stable coins offers some benefits. Can you talk a bit about what is called the Genius Act in the United States, which, as I understand it, represents a pretty significant shift in how the US is approaching from a regulatory perspective?
Yeah, so the Genius Act represents, I think, a maturation of the stablecoin regulation from a patchwork of sort of oversight and sort of a move to a more comprehensive framework, anyways, in the United States, anyways, and so being the largest, our largest trading partner here to Canada, and I think globally, I think many jurisdictions are looking to what's happening there in that space. And so the Genius Act, for your viewers, it's the acronym stands for Guiding and Establishing National Innovation for U.S. Stablecoins Act, which passed in July 2025 with bipartisan support, I should say, in the House and the Senate, and is currently working through what those I think there's an 18-month implementation window for the regulations. And so, um, I think it's the key regulatory framework for stablecoin issuance right now globally. Um, it's a federal licensing system um, with unified oversight. So it's a single federal license versus a state by state sort of money transmitter laws. It eliminates that sort of regulatory patchwork of what's happening. And I should back up and say that, since in the past year or two, the regulatory stance in the U.S., to your point, Michael, has been much more tech forward and innovative. I mean, here at the CSA, we're constantly looking at what the SEC and the CFTC are doing, and in very close contact with our colleagues there, and seeing what they're working through. And so the SEC Crypto Task Force has made some very many positive statements um, uh, towards the space, and has been a bit of a 180-degree turn since from the previous administration. And so I think that has brought a lot of excitement to the space. Um, and I think the Genius Act is just another piece of that puzzle. And I think a lot of it addresses a lot of the risks that we've sort of already talked about, but from imposing sort of a prudential regime for stablecoin issuance in the US. So it addresses sort of the one-to-one backing, ensuring full collateralization with high quality liquid assets. Those eligible assets are US Treasuries, and I think right now there's a max 90 days on the redeemability of those treasuries, cash and cash equivalents. There's segregation requirements, so customer reserves are held separately and apart from issuer assets, and so I think that it addresses some of the bankruptcy and remoteness of reserves that we talked a little bit earlier. There's daily reconciliation requirements for real-time proof of reserves and public attestations. And then again, it addresses some of those consumer protection concerns that we've been discussing. So, redemption rights. So a one-to-one redemption guarantee. I think Genius requires it within 24 hours. There's disclosure requirements, so clear terms and risks on reserve composition. There's customer prioritization. So claims on the reserves are superior to those. And this is a big piece, I think, with any stablecoin structure, is that claims on reserves from token holders are superior to those to general creditors in the event of an insolvency of the issuer. Then there's also a requirement for sort of a complaints process with federal oversight. So token holders can file complaints or have some sort of grievance process that they can engage in. There's also an important piece here on operational standards. So issuers having minimum capital requirements based on sort of outstanding stablecoin volume. Risk management, so comprehensive cybersecurity policies in place and operational risk controls.
That is a very comprehensive regulatory framework that you've just described. Where does Canada stand with respect to stablecoins? Is there an equivalent? Or is this an area that, at least for the moment, just stands unregulated, and so we don't see the same kind of interest in growth?
Yeah, so I mean, in Canada, we are, I would say, I mean, I think this is, sort of common knowledge, but we're sort of idiosyncratic compared to what the rest of the globe is doing. At the CSA, we asserted jurisdiction over stablecoins and CSA Staff Notice 21332 back in February of 2023. And so, and we asserted, jurisdiction over them on the basis that we believe that fiat-backed stablecoins in particular are a security and/or derivative. And so some of the background and catalyst around that, if you rewind a little bit, and we talked a little bit about that already, was the FTX collapse and its impact. So the bankruptcy highlighted, a lot of different custodial type risks. And so that regulatory response was an accelerated timeline for some of the platform registrations that were taking place at the time. Just say that the CSA regulates the crypto market in a sort of unique way, through the basis of what we call the crypto contracts, which we outlined in CSA Staff Notice 21327, which is the based on this idea that an entity like a crypto asset trading platform, or CTP that we like to call them, hold crypto assets on behalf of customers for their benefit. And so based on that custodial relationship, we exerted jurisdiction. And so we issued a pre-registration undertaking with some key requirements for those CTPs, and a lot of those were client asset segregation, custody restrictions, and trading limitations such as no margin or leverage or lending to clients. But as part of that, there was a prohibition on listing value reference crypto assets, or otherwise known as stablecoins, without any CSA consent. And so because CTPs are sort of the main distribution channel for these in Canada, they were restricted from listing them. I should mention that we did expressly ban the use of, or the issuance of, algorithmic stablecoins in that same staff notice. And so we issued sort of a timeline there on how to come into compliance. And then, in October of 2023, we issued CSA Staff Notice 21333, where we defined what a fiat-backed crypto asset is, or an FBCA, or fiat-backed stablecoin. We defined it and gave some scope to the market there. So, that criteria is it's a single fiat currency peg with, must have adequate reserves and some of the redemption rights that we've sort of talked about in length. And only stablecoins meeting sort of these strict requirements were allowed to be listed on these various CTPs, and then at the same time, prohibiting algorithmic and other types of like multi-currency types or commodity-backed type stablecoins. And so we issued some of these detailed requirements for these, and among those were reserve standards, so one-to-one backing, asset quality, segregation, independent attestations. I think globally, Michael, we can say that there's been a consensus around what the risks are and how to address them around fiat-backed stablecoins. And so I think that, much of that dialogue and discussion, I think, has been settled, but it's just, the question is now how to implement them. And so we issued, requirements around redemption mechanisms, so direct redemptions, timely settlement, no fees or penalties, sort of legal certainty around the clear contractual rights that token holders have to the underlying assets. And so I think you can kind of see the analog a little bit between what we've done here at the CSA, and some of the other prudential regimes globally. But it should highlight that we issued this staff notice as an interim approach as we work towards a more long-term framework. So almost a stopgap measure, if you will.
There's a lot of acronyms in there,
Yeah.
and a lot of numbers, but
Yeah.
what I'm taking away from this is that, at least the Canadian Securities Association regulators kind of found themselves finding ways to try to provide at least some amount of protection, identifying some of the kinds of safeguards that you identified, whether it's redemption or asset quality and things like that. Working together with those, I think you call them CTPs, those that basically provide the platforms for people who might engage in crypto to say, listen, if you want to be able to list these are some of the standards that you have to meet. But you mentioned that this kind of comes in the aftermath of some real concerns about there's some people are buying these things with some real risk that seeks to address it. If we contrast that with the tech forward approach that I think as you described it in the United States, they're rushing ahead not solely to protect, but really envisioning adoption. Where do you see us going in Canada? Are we likely to see a Canadian denominated stable coin? Do we have the framework in place to allow that to happen? You know, what sort of what needs to or what might happen to allow Canada to in a sense match what is taking place elsewhere?
Yeah, I think there's been, it's a great question. I think, I mean, right now I can only speak from a CSA perspective. I mean, right now, there is a path to issuing a Canadian denominated stablecoin in Canada, and that's by way of a prospectus offering. Obviously, there's other avenues, and there's been some public announcements by entities in the marketplace that are trying, well-known financial entities in Canada that are attempting to bring one to Canada. I think there's been some public statements. I mean, I won't comment on what other regulators are doing, but there's been some public statements from believe the Department of Finance, Bank of Canada, OSFI, where there's been some signaling on something, maybe potentially happening. I think, as much as I do in that respect. And so, I mean, I think it's sort of a wait and see approach. But I think, as I can say from what I'm doing here at the ASC and the CSA, we're thinking about these types of issues all the time. I mentioned Dr. Ryan Clements, who chairs the CSA's Financial Innovation Hub, and I work very closely with him there in that respect, where we think about these types of financial innovations and these types of emerging risks to Canada's, capital markets, and we, try to think about ways on how to address in a tech-forward way, how to address some of these financial innovations that might be of benefit to Canada's capital markets. And so, as part of the CSA Financial Innovation Hub, it's sort of a three-pronged approach. We have this research pillar where we do a lot of work relating to various different types of financial innovation. So, things like AI, for example, we recently released a staff notice there on the applicability of AI securities rules to AI and a consultation there. But we also have this great initiative called the Collaboratory, which is a thematic style sandbox environment where we identify themes, for example, that might be of benefit to Canada's capital markets. And so we have an active project there right now on data portability, which is sort of intersects with some of the open banking stuff that's happening at the federal level. But we're also thinking about sort of this space right now, not just stablecoins, but more broadly, I think tokenization and how tokenization might play a role in modernizing sort of legacy, infrastructures where, in my view, stablecoins play a foundational piece in the plumbing of that new market infrastructure.
Okay, interesting. Well, perhaps tokenization will be a future topic in terms of how it may impact things. Why don't we close with this? You've been focused on this area for a long time, both identifying some of the growth that was taking place and some of the regulatory risks. We're seeing very rapidly changes taking place. You've talked about in the United States, you talked about some of the discussions and the interest that's taking place here in Canada. Where do you see things headed over the next 5 years? Is this something that is going to become increasingly mainstream, so that the starting point that we had on this podcast is explaining the 101 of stablecoins will become less and less necessary as people will become more and more familiar with it? And do you foresee the prospect of Canada becoming a player here, or is the U.S. point of emphasis of basically creating that regulatory framework that we talked about, seeing some of the capital markets move in, is Canada going to struggle to have an impact in a space as it grows?
Yeah, I mean, I think a lot of I got to say, I'm an optimist, and so I'm really excited for what sort of like the future might hold. I think there's a lot of great market participants here in Canada, a lot of smart people working on some really great solutions. I think it's hard to, you can't uninvent this technology. I mean, I think it's here to stay. I think when we're thinking about sort of user experience and how this might benefit the market and how it might contribute to the productivity of Canada's economy, I mean, I think it's sort of hard to deny. I think when we're thinking about stable coins in particular, I mentioned sort of the current market cap at, 300 billion. USD globally, but I think it's important to remember that that's in US dollars. And I think with the implementation of the Genius Act, there's been a lot of different jurisdictions that are starting to think about, well, maybe we should be thinking about creating our own type of stablecoin framework to address the US dollar dollarization of our economies. And so I think that's a fair concern for many foreign jurisdictions to have. And Standard Charter has projected that the stablecoin market will be 2 trillion by 2028. And so that's an enormous growth rate by any metric. JP Morgan's a little more conservative at 750 billion by 28. But I think it's important to recognize that this market is growing and it's growing exponentially. Some of the growth drivers are, institutional adoption, payment modernization, decentralized finance maturity, and maturing emerging market adoption. And so when we're thinking about sort of payments and what it does for payments, I say this very broadly, not just in retail payments, but instantaneous settlement, when you're able to take sort of clearing and settling infrastructure and collapse those into sort of one transaction and move from, say, T2 to 5 day settlement to T+0, and bring some cost efficiencies to it. I think it's hard to not see how mainstream financial system integration is starting to wake up to the benefits of this sort of underlying technology that used to only just exist in sort of the crypto space. So I think Canada's strategic position and opportunities are great. I'm just speaking from sort of like the personal innovative innovation space. I think there's a lot of great work being done here and a lot of great fintechs that are thinking about how to sort of modernize that. We have our own types of complexities in Canada that are different than other countries that sort of need to be dealt with. But I think there's a big opportunity for Canada to sort of be a leader here in this space for sure.
Okay. All right. Well, it's nice to close on an optimistic note so often on this podcast. I don't. So I'm happy to hear the optimism, and it's a complex area, but one that, as you suggested, even some of those projections suggested the impact is going to continue to grow. And so thank you so much for coming on the podcast and helping to break it down.
Thanks for having me.
That's the Law Bytes podcast for this week. If you have comments, suggestions, or other feedback, write to lawbytes@pobox.com. That's LAWBYTES @POBox.com. Follow the podcast on Twitter @LawBytesPod, or follow Michael Geist @MGeist. You can download the latest episodes from my website at michaelgeist.ca, or subscribe at iTunes, Google, or Spotify. The Law Bytes podcast is produced by Gerardo Lebron Laboy. Music by the Laboy brothers, Gerardo and Jose Lebron Laboy. Credit information for clips featured in this podcast can be found in the show notes at michaelgeist.ca. I'm Michael Geist. Thanks for listening, and see you next time.